If you earn over $1 million a year, you already know how fast taxes can eat into your success. You work hard, you invest, you take risk, and then one check to the IRS can wipe out months of effort. Now here's the twist. A new law passed in 2025 quietly changed the way high-income people get taxed. On paper, it still says 37%, but in the real number, the one that hit the bank account isn't the same anymore. And here is the opportunity for a short window, 2025 to 26. You can legally reposition your income and deduction to save tens and even hundreds of thousands of dollars. So, in this video, we are going to talk about what this 37% ceiling really means now, why $1 million earners like you are sitting on the biggest planning opportunity of the decade. Third, what simple moves you can make step by step to keep more of what you earn. Why this matters to you. If you make $1 million a year, you are probably paying around $320,000 to $370,000 in federal income tax. That a third of your income is gone. Now, under the new law, the rate didn't jump higher, but the rate behind them shifted. Think of it like this. The road stayed the same, but the speed bump moved. If you keep driving the same way you did before, you will hit every bump and pay more. But if you adjust how you drive, when you earn, when you give, how you structure your income, you glide right over and keep more of your money. What actually changed? So before 2025, the 37% bracket started lower. Now it started higher, around $750K for married couple. So you have more room before hitting the ceiling. But here what most people don't realize, it's not just the bracket that matters, it's all the extra layer that sit on top. Investment taxes, limits on deduction, and how your business income is taxed. Here's what changed that you should care about. First, the rates stay, but the window widened. You have a bigger space to plan before hitting the top bracket. The business deduction survived. If you earn through an S-Corp or LLC, you can still take up to 20% of your business profit before tax. Charitable giving got stricter after 2025. You can still give large amounts, but the deduction rule tightened next year. So, 2025 is the sweet spot for big gifts. State tax deduction improved. Temporary. If you live in a high tax state like California or New York, you can now deduct more of those state taxes on your federal return, but that window won't last long. I want to share with you about Michael and Dana, who run a consulting business in LA and make about $1.2 million a year. When the new law passed, they asked, should we take our bonus this year or next year? Here's what we did for them in simple terms. First, we ran both scenarios side by side. Second, we saw that 2025 rules get them a wider deduction window and better charitable limits. Third, we have them pay themselves $150K bonus in December 25 instead of January 26. Fourth, they donated to their favorite charity in 2025 to capture the higher deduction. Fifth, they prepaid some California taxes while the SOAP limit was looser. That move along saved them about $40K in federal tax. Same income, same work, but smarter timing. Fourth, how you can do the same. Let's break it down step by step with plain actions you can do. Step 1, know where you stand. You can pull your year-to-date income and see roughly where you are. Are you close to that $170K mark or way above it? So this tells you how much room you have before the 37% rate hits. Step 2, decide which income you can control. Do you own a business? Have a year-end bonus coming? Stock sale? These are the levers you can move. You can shift more of it into 2025 to use the lower effective rate before rule tighten in 2026. Step 3, plan your giving. If you normally give $100K to charity each year, consider doubling up in 2025. Make your 25 and 26 gift this year. You get the full benefit before the new restrictions start. Step 4, review your business pay. If you own an S-Corp, don't just take everything as salary or everything as profit. The right mix let you qualify for the 20% business deduction, and it's a big deal. Step 5, look at your state taxes. If you live in a high tax state, you can currently deduct more of those taxes federally. Prepay what you legitimately owe before the window closes. These are simple moves that most million-dollar earners miss because they are busy running their business or their life, but each move adds up to real savings. Why is this urgent? After 2026, many temporary benefits fade. Some deductions shrink. The IRS tighten phase out for high income earners, and that means the window to plan ahead is short. If you wait until next tax season next year, it's too late. Tax planning isn't something you do in April, it's something you do before December 31st. So if you earn over $1 million a year, this is the moment to act, because when the calendar turns, you can't go back and shift income or deduction retroactively. The big takeaway that I want you to walk with this is the new law didn't raise your rate. It gave you a short window to reshape your tax story. If you ignore it, you will pay what everyone else pays. If you plan for it, you will save what everyone else losses. Think of it this way. Your tax bill is one of your biggest expenses each year. You wouldn't let your business spend hundreds of thousands without a budget. So why let your tax money go without a plan? You don't need complex formula. You need a simple map. Earn smart, give smart, pay yourself smartly, and time it right. That's how you turn the 37% ceiling into a profit strategy instead of a penalty. To run your own numbers and see how much you can save, download the 1 million plus tax projection sheet at Pro Deductions on Etsy store, and learn the advanced planning step at accessyinstitute.com. Thank you for watching. I'm Mia. I will see you at the next update.